All right, hello everybody. Welcome to another episode on my channel. So today we'll be doing a quick weekly portfolio update, followed by a deep dive into one of my favorite equity holdings, Lowe's. We'll be looking at an investor presentation from their CEO. We'll be doing a financial trend analysis. We'll be examining their latest quarterly earnings, looking at those financial statements in detail, and then we'll be looking at what their stock has averaged as an annual return over the past 20 years against the relevant indices and benchmarks. So without further ado, let's go and dive right into the content. This is a no fluff channel, and I like to focus on the quality of the content as opposed to the quantity. So let's go and look at my weekly portfolio update. So here is my weekly portfolio update. You can see my tracker here. If you're familiar with my channel, you should be familiar with this spreadsheet. This has my current stock allocation here, my sector allocation, my annual dividend income per stock, and my gain and losses percentages as well. And here you can see my gain and loss here in this nice table. So feel free to pause or take a screenshot if you would like to. And I'm going to actually move on to the actual performance of each of the holdings. So here's the holdings. I'm gonna make this a little bit bigger so you can see. Perfect. So we can see Microsoft is doing pretty well, up about 28%. Apple up about 32%. They just crossed 3 trillion in market cap this week, so that was great to see. TD Bank basically break even. CP Rail up about 19%. JP Morgan up about 28%. Texas Instruments up about 10%. Amex is up about almost 18%. Visa up about 20%. UNP up about 4%. Brookfield Corp up about 8%. Bank of America up about 3%, Costco about 26%, Lowe's up about 14%, RBC up about 5%, T. Rowe Price down about 3%, NSC up about 9%, Home Depot up about 3%, Manulife basically break even here, Realty Income down about 1%, basically break even, VG Properties up about 2%, CSX Corp up about 11%, and Agri Realty basically break even. So in terms of the movement this week of this portfolio, I actually sold a couple shares of Microsoft, and I took those proceeds and I invested them into some of my lower weighted companies or holdings, such as Realty Income, VG Properties, and Agri Realty, as these REITs have come down a lot in price, and I feel like they're trading at a more reasonable valuation than some of these tech companies, such as Microsoft and Apple. But I didn't really sell off too much, just a couple shares, because I also believe in these companies long term, but the way that they're trading right now at these valuations is extremely high. So I did want to take some profits here, lock those in, and allocate them to some more reasonably valued companies. I also added some more shares of Brookfield Corp, as well as I still feel that's significantly undervalued. So what you can do is actually pause or take a screenshot here if you like at any point in the video, in case you want to save this for reference for your own investments. Now what I've done here is I've frozen this pane here in the Excel spreadsheet. I'm just going to scroll over, and then you can see my actual allocation into these companies. So I have my desired allocation. So this is the percentages I would like in a perfect world if I could attain this, the percentage holding of each of these equities. And this is my actual current allocation here. So I still have some cash here that I can deploy, about 2%. And I have some cash sitting in some other accounts, which I haven't added to this portfolio in case I see buying opportunities. But again, feel free to pause and screenshot if you would like to see my current allocation compared to my, desired allocation. But I'm going to, this is pretty fluid. And again, you'll notice this is a 2% deviation from 100%. And again, that's on purpose. I'm not trying to, get this exactly right. Just as close as I can to this desired allocation would be my preference. But again, the market moves, some equities go up and down, so you can't really control it. My goal is to just buy, reasonably valued companies at significantly undervalued prices if the market allows, or reasonably valued as long as I have the cash and I see the future growth potential. And again, it's all in equities here. So feel free to look at that if you like. So that was the portfolio update there. Now, again, let's go. I said I was going to talk about Lowe's here. So Lowe's makes up, about 4.1%, as you can see here, of my current stocks or in this portfolio or this allocation. So it's actually pretty significant. So we're going to go and look at the CEO's investor presentation. This was in December 7th, 2022. And this was his presentation. So again, I'm pulling all this from the Lowe's corporate site. So it's all available there on the Lowe's corporate site. You just have to go and look at the subheading under investors, and you can access all of this information as well. So their CEO, Marvin Ellison or Marv Ellison. So let's look at the results from 2018 to 2022. They're plus 36% for your sales growth. That's great. Adjusted operating margin up of 440 bips or 4.4%. Earnings per share growth is up 169%. So that's really great. Their sales growth is a lot slower than their earnings per share. So right away, that kind of tells me they're probably buying back a bunch of shares, but we'll look at that later when we look at the financial trend analysis. 500 bips here in customer service scores, so 5%. 141% of total stock return over this time. So that is awesome. And then 43 billion in capital return to shareholders. So by them putting this here, they're emphasizing that they prioritize their shareholders, which is very great to see in a company that I've invested in. You can look at their leadership team here if you like. Values and culture, so it's just describing their core behaviors, their core priorities, focusing on customers, taking action, continuous learning, supporting their associates, serving their customers. This all translates into increased shareholder value. Again, prioritizing or communicating that they prioritize the increase in their shareholder value. So this has been their transformation or transformative timeline. They had these retail fundamentals in these years. They were trying to improve these operating capabilities. And now they're focusing on accelerating their market share in gains in both do-it-yourself consumers and pro consumers. So do-it-yourself consumers, that's where if I went and I was buying, building my own basement or even, replacing some doors in my house and things like that, but I was going to do it myself. And then the pro consumers being those home builders or home contractors. So Lowe's has traditionally had a revenue breakdown of about 80% to 75% in the DIY sector and about 20 to 25% in the pro sector. But they're really focusing on trying to duplicate Home Depot. So Home Depot, again, being the larger competitor here, they operate in a duopoly in this home renovation and home improvement market. So Lowe's is trying to catch up to Home Depot, if you will, in terms of the percentage of revenue. Home Depot has about 50% of revenue coming from the do-it-yourself and 50% from the pro segment. Again, Lowe's is kind of split 75-25 here, and they're trying to catch up to this pro segment because the pro segment, if you can build those relationships, the pro contractors, they don't do as much volume as the do-it-yourself contractors, but they do have a significant amount of volume. They buy a lot more in terms of their projects and purchases, so it's a lot more revenue, and it can be more projected upon and kind of like a continuous form of revenue, if you will, if they build these relationships, and it's easily to be projected or estimated based on the quality of their relationship with the pros. Total home strategy here, you can see that they're accelerating their market share with these do-it-yourself and pro consumers. So trying to drive this pro penetration, break more into that market, gain more market share there, accelerate their online business, expand their installation services, drive localization, and elevate assortment. So this is kind of speaking to what I was saying before. 75% here is lowest penetration in the DIY, and then 25% to the pro. And they're trying to get the total home improvement market to be more of a 50-50 split for their revenue drivers or growth drivers. And it's like you can see what they call HI, the U.S. home improvement total addressable market. It's at about $1 trillion. So it's very large and highly fragmented. So what they mean by highly fragmented is, Home Depot and Lowe's have a great market share in this home improvement market or the HI market, but there's a lot of mom and pop stores, a lot of independent stores. So that's a lot of assets out there with customers that they can try to capitalize on or gain market share in. And that's what they mean by highly fragmented. So that's a huge opportunity for them to try to gain market share from that total home improvement addressable market. So the long-term, home improvement market growth drivers, they split them into three different categories: U.S. housing stock, consumer finances, and demographic trends. So U.S. housing stock, home price appreciation. Homes have gone up a lot in price. The age of the housing market, 50% of homes are 41 years old. So by them, being older, they'll need more improvements or more renovations. So that's more revenue streams for Lowe's to continue to keep growing. undersupply of homes, 1.5 to 2 million units. So there's not as much homes in the market. They'll need to continuously be built, and therefore contractors will need Lowe's building supplies. Consumer finances, so disposable income, 1.5 trillion in excess savings, and it's very concentrated in the 40% of income earners. So disposable income, people will want to spend this income on improving their homes supposedly. So that's could be a big growth driver as well. And record homeowner equity. So again, with this home price appreciation, people have a bunch of equity. It's at an all-time high, 330K, the average of homeowner equity that they can pull in order to make more renovations to their existing homes. Demographic trends, millennial households, they're buying, first-time home buyers are breaking into the housing market, so that again will fuel growth for Lowe's. And they might be buying some of these older homes and renovating and fixing them up, so they'll have to go to Lowe's to buy specific materials and things like that. Baby boomers, so baby boomers, a lot of them from my experience, have kept their homes and then they'll need to renovate those. And then there's also the wealth transfer. So baby boomers, passing down homes to millennials, and then they'll need to fix them up, or baby boomers passing down some of their wealth to their millennials in order to buy new homes as well. Remote work, so a lot more people are still working from home. 50% in office occupancy versus pre-pandemic. I don't expect this to change at all. If anything, it might stagnate or continue moving into the more work from home segment. So as people work more and more from home, they want a nicer home because they're spending more time there, or they want to build an office and things like that. So again, they'll have to go to Lowe's to get those building supplies. So here you can see home building versus home improvement. The demand drivers for both of these are different and distinct. So for home building, it's more discretionary based on if mortgage rates are higher or lower, if people can afford new homes, and labor and supply constraints if contractors can actually build these homes fast enough. Home improvement demand drivers are less discretionary because you have home price appreciation, aging of the housing stock, and disposable personal income. So that's two different segments here to note. But again, Lowe's benefits from both in different economic conditions at different times. Home improvement spend in the 1990s, this is just showing, well, if the interest rates were relatively high or where they're kind of comparable to where they are now, what happened to the home improvement retail sales. It's kind of showing that in single family housing starts. So you can, pause, take a screenshot. I don't really give much credence to this because this is kind of older data. It's from 93 to 97. I guess they're just showing what happens when interest rates rise, the effect, and that home retail sales still continue. So here they're saying who they will win with and how they will win with. So millennial homeowners with kids and baby boomers. They're saying they'll win by providing everyday value, innovative products. They'll have the brands that they require. They'll have seamless experience shopping, localized assortments, and install solutions. So again, just kind of detailing their strategy high level. And here's how they're gonna win with pros. So this has been a huge focus of their business in the past little while. Here's the Lowe's Pro customers that they call tradespeople, repairs and remodelers, property managers, and they want to make a one-stop shop for these pros by having the brands and products that they require, having a lot of quantities, having a fast and simple shopping network, job site delivery, and financing, and thereby creating all of these, they'll be able to create loyalty for these pros, which will allow for a lot of recurring revenue in this business. So here you can see their, perpetual productivity improvements. So how they're saying they're continually, increasing or improving their productivity. So they're having a lot of technology integration, simplifying a lot of operations, simplifying their selling, and trying to create this frictionless customer and associate experience. So this is really cool. When you think of Lowe's, you don't really think of it as a technology company, but technology is in the backbone of every business basically now. So what they're doing is you have these 30-year-old systems, and as you can see, they call them the legacy systems here. And over each of the years, they're phasing these out and they're replacing them with these modern systems in order to allow them to gain market share and improve the customer service experience, as you can see here, and increase their productivity as well. This ultimately drives sales and increase their customer service. So here you can see they're being a responsible corporate citizen, so talking about their community work, their associate work, and things they do in order to make the world a more sustainable place. Again, more on that if you wanted to look at that, their brand reputation. So here are just the key investment highlights. Again, uh, they have a resilient business model. They've been doing this for a long time. They're taking market share across both DIY and pro consumers. They're well capitalized and they're investing in their channel capabilities, significant productivity, expansion opportunity, and disciplined capital allocation, which we will look at in just a minute when we look at their trend analysis. So that was the investor presentation. Again, not really a lot of numbers in here. It's just more of their overall investment strategy and how they plan to continue to grow as a company. So it's important. A lot of people just look at the numbers, but you do need to look at this as well in order to get an idea of how the upper management or executive management sees growth in both a quantitative and qualitative aspect. So that is really great to see. I would encourage you just to read through it. They have a couple of those, so I'd encourage you to go to this site and look at those. Now let's go and look at Lowe's. So this is one of my portfolios that I share on the channel. Let's go and look at Lowe's. It's here in this portfolio. All right, we're gonna look at it annually. So Lowe's trades under the ticker symbol LOW. It's on the NYSE or the New York Stock Exchange. Right now it has a market price of $225 here. So as we scroll down, we can see some other aspects of Lowe's. Market cap of 132 billion, so it's large cap. Price to earnings ratio at about 21, and forward price to earnings ratio at about 14 to 15. So that's the price to earnings, is valuation metric if you'd like to look at that. They have some other ones, price to sales. They have some price to book, and then the EBITDA as well, so you can look at that. Dividend, so this is a dividend growth company. So right now they're paying a respectable dividend at about 2%, and the payout ratio is at a nice almost 40%. So they have a lot of room to grow that dividend over time. Again, the payout ratio is the amount of dividends that they pay relative to net income, so it's still relatively low. Profit margins and operating margins. So we can look at the operating margin, it's at about 12.8%, and their actual net profit margin is 6.6%. So it's not super high, but it's still respectable. Retailers and home improvement stores, their profit margins are a lot lower than, say, other companies such as Visa and stuff like that, which have 50% profit margins, or other technology companies such as Apple, which have 30 to 35% profit margins. So it's lower, but it's still respectable. Here we can see a snippet of their balance sheet. So they have 3.3 billion of cash and a lot of debt, 35 billion of debt, resulting in net debt of 32 billion. So that's something to be super aware of. So this is not a cash positive company. It's a net, pretty indebted company. So they're leveraging a lot of debt. And by leveraging, that means, taking on debt in order to try to get higher returns that they can in terms of the financing amounts that they would be paying for that debt. And we'll have a look at that debt in a minute as well, and how I feel about that. Generally, I don't like my companies to be very indebted. I like them to be cash, producing a lot more cash than they have debt. But we'll see why I'm okay with this in a minute. Let's look at their revenue. Revenue has gone up, respectable rate at about 6.75% per year over the past 10 years. Again, it ebbs and flows with demand and of the economy in terms of homes and home building and home improvement, but pretty respectable. EBITDA, so that's earnings before interest, tax, depreciation, and amortization. So again, ebbs and flows, but it's gone up at about 8.88% per year over the past 10 years. So that's great. Let's look at their net income. Net income is, growing pretty rapidly at about 12.63% per year over the past 10 years. So that's great to see as well. Now the earnings per share. So the earnings per share growing at a very high rate, a lot higher than revenue, EBITDA, or net income that we saw. It's growing at almost 20% per year over the past 10 years. So one thing that we need to remember with earnings per share is that the earnings, so that's the actual earnings of the company, divided by the shares. So when you have, earnings per share growing at a higher rate than the actual earnings, that tells me that they're buying back a lot of shares and that they're canceling them out. So what we want to do is go and look at the shares outstanding. So yeah, they've been buying back shares at a very high rate. They've been taking those shares out of the equity markets, buying them back and canceling them, and by doing that, making you a larger equity owner in the company. So your percentage of ownership goes up as they do that. That is super great. I usually love companies that do this because you're becoming a higher percentage equity owner in the company without you having to do anything. And they've been doing that over the past 10 years at almost 6% per year. So it's very high. So that's great. The only caveat to that is when we look at their cash and debt, like we saw. So the cash here is in the green, the red here is the debt. The peach here is capital leases. So that's an IFRS 16. You don't need to really dive into that. That's more of an accounting lingo, but essentially the new standards of accounting require you to record these, leases that you had for their warehouse and things like that as both an asset and a liability. So it's recorded as debt, but it's not really debt. It's just the rent payments that they have to make. So, but as we get back to the debt, we can see it's been racking up pretty high, and it's because they've been using this debt. Like I said, they've been leveraging that debt to buy back these shares. So the way they look at it is we can take on this debt, buy back these shares, increase our earnings per share like we saw up here, and rewarding shareholders that way. The only thing is that can end up being a very dangerous game, because if you take on a bunch of debt and you cannot service that debt or pay it all back, then it becomes a major problem. So my rule of thumb is I like to invest in companies that are able to pay off that debt within 3 years by looking at their EBITDA. So if their total debt is less than 3 times their EBITDA, then I'm usually okay investing in those companies, because all things being equal, they can stop buying back those shares in, for 3 years or things like that, and then pay back that debt and kind of be at a net cash position again. So if we look at their, 2022 EBITDA, 2023, still going on. We look at their 2021. So we say 12 billion to about 14 billion. So we'll take the average there at about 13 billion of EBITDA. If we times that by 3, so it's 13, 26, 39 billion of EBITDA. And their debt right here is 35 billion. So they're still able to service that debt within 3 years. So I'm okay investing in it, but just be aware of that when you're investing, because as that might not meet your risk profile for investing into a higher level leveraged company, or a higher levered than normal company. But again, for me, it's 3 times EBITDA. If it's under that level, I'm okay investing in that. And personally, I would actually prefer if they stop buying back all of these shares, and if they've instead focused on paying back the debt, I'd be okay with that for a couple of years, because I would understand that goal, in the long term, is to pay off a bunch of that debt, and then they can get back to buying back those shares later using their EBITDA or their earnings from operations. Now, again, their dividends here, I bought them as a dividend growth company because they grow their dividends at a very, very high rate. They've been growing them at about 21% per year over the past 10 years. Their last couple ones were 33% and 30% respectively. And then they just made one I think it was a couple weeks ago. They increased it by about 5%. So not as big of a raise, as I think that they are, just being cautious in this time that, higher interest rates and things like that, they might expect to slow down. So they've just increased it by 5%. But again, 5%, that's still a very high dividend rate increase. So that was the trend analysis for Lowe's. Again, just super high level. I like to look at Qualtrim for the graphs and things like that, because it's very easy to see in a graphical representation. But now we can actually go and look at the financial statements in their most recent earnings. So here we have their, again, I'm just pulling this all from their site on the Lowe's investor section. So this is in millions. And we're looking at their most recent quarter, which ended May 5th. And then that's comparing to the same quarter in the last year, which ended April 29th. So again, around an April 30th kind of ending in terms of the quarter. So they had net sales of 22 billion. And for the same quarter in the last year, they had about 23 billion. So they had a decrease in net sales from that same quarter. And the cost of sales, again, would be down because they did not sell as much. So the gross margin, or the gross sales here, being at 7.5 billion compared to 8.5 billion. So they did have a decrease there in the number of sales from the prior quarter in the same year. So here we can see their expenses. So their selling, generally, and administrative expenses went down. So that's good. And then we can see their operating income, once we net all that out, is about 3.2 billion, almost 3.3 billion. And here it had about 3.3 billion in the same quarter. So again, basically the same as the prior year in the same quarter. So a little bit of a decrease, but they've kind of kept that same operating income. So that's great. There's not growth here because they had an amazing year in 2022. But again, they're staying relatively comparable. And then here we can see, there's the tax earnings, the income tax provision, and then the net earnings. So 2.2 billion, almost, 2.3 billion. compared to 2.33 billion. So again, this net earnings again being a little bit lower than the same quarter in the prior year. So that's why you've seen a lot of these, home building stocks kind of come down in valuation, because their earnings have gone down a bit, or they're not growing as much. But 2021, 2022, like these years were anomaly years because they had such great sales. So this should have been kind of expected by people, that type of sales growth cannot continue the same as it did in 2022. So again, returning to a more normalized average level of sales. And then again, here we can see the earnings per share at about 3.78 per share, compared to the same quarter about 3.52. So again, speaking to this, how can they have lower earnings here in this year than they did last year and still have a higher earnings per share? That's because they've reduced those shares outstanding. They've bought back a bunch of those shares. As you can see here, they had about 660 shares compared to 596 million shares. So they reduced those shares right there, thereby increasing their earnings per share. So now if we scroll down, let's go and look at their balance sheet. Okay, so if we look at their balance sheet, we can see, they have a little bit less cash than the previous year, a little bit more in short-term investments. They are, relatively keeping the same amount of inventory here. And then their total current assets are basically in line, just a little bit less of cash. And then their property plant, we don't really need to dive too much into that. That's the property, plant, and equipment, less depreciation. And then here's those, those leases that they have to record. So they have to record them both as an asset here, and then also as a liability here. So again, those are just the leases that they have to record. It's just the lease payments. So again, don't really look at them as an asset or a liability. It's just because of an accounting standard. So here we can see their total assets of about 45, billion dollars or whatever. So now if we scroll down, we can then look at their liabilities. So current maturities of long-term debt, 589 million. So again, that's well covered by their cash. So the current portion of their long-term debt, they can easily pay with that cash that they have. They have accrued compensation employee benefits here. They have accounts payable. And again, these total current liabilities, 19 million, it's not that much compared to the actual total current assets. They could just pay those off. Now this long-term debt here, like we saw, is about 35 billion. So they've actually, compared to the prior period, they've racked this up by another 7 billion. So that's not something I really like to see, is this racking up of debt. But again, they're using that debt to buy back those shares like we saw. So they're taking a levered position and buying back those shares as they feel that that's more, accretive to shareholders. That's their capital allocation strategy. They're taking on more debt in order to buy back those shares because they feel like those shares are at a better value than the actual debt servicing cost or what they have to pay in interest. But again, if it was up to me, I would kind of prefer now them to use some of the cash that they generate and start to pay off that debt. But we'll look at that in the cash flow statement. And then here you can see their total liabilities of 60 billion. So again, it's really mostly made up of that long-term debt here. So scroll down and look at the cash flow statement. So here you can see their net income. You get to add back, non-cash charges like depreciation, amortization, the gain on the sale of the Canadian business here, their share-based compensation, and then you get their net cash right here. So it's about 2.1 billion. So they generated less net cash than they did last year. But again, you have to look at the net earnings here a little bit less as well. And the net cash here at about 2.1 billion. Now they had some purchases of investments. Capital expenditures, not really a whole lot. And so net cash used in investing activities, fairly consistent with the prior quarter in the prior year. So that's good. So here we can see the net proceeds from issuance of debt. So they took on, another 3 billion of debt here, but like the repurchases of common stock. So this is really where that debt is being used. And they've taken on this debt here to keep their cash balance. And then if you look at the actual net cash, 2.1 billion, that's the exact amount that they used to repurchase was common stock. So they took on some more debt to keep some cash in their bank account, and they used the cash from their operating activities to repurchase that common stock. Now, as you can see, it's less than they did last year. and they did increase their dividends. So again, they're taking on this debt to buy back this stock, which is fine because they're providing shareholders, value that way. But that's just something to be aware of when you see these earnings per share numbers. Just remember they're taking on debt in order to do this. But like I said, for me, I'm comfortable with it, but a lot of investors might not be. So that's just something to keep in the back of your mind. So that's their cash and cash equivalents at the end of the period. So yeah, that was their financial statements. A quick walkthrough there, kind of just how to read those. Key takeaways there: their sales have gone down a bit, like we saw, but they're still relatively in line with the same period last year. They're buying back shares at a high rate, so they're increasing their earnings per share. But again, remember they're taking on debt to do this. If it was me personally, I would prefer them to reduce the amount that they're doing this, spend a lot of that cash flow that they generate to instead start paying down the debt. And by paying down the debt, they would be able to go to a net cash position, and I'd be okay if they stop buying back shares for a while, and if they just kind of focus on paying the debt and increasing the dividend, that would be okay with me. But again, this is all part of their capital allocation strategy, and Home Depot does basically the exact same thing. So that's something to look at as well. Now let's go and look at the average stock annual return. So I'm just here on averageannualreturn.com, and what I'm going to do is chart their performance over a 20-year period for Lowe's compared to S&P 500. So here we can see the growth of $10,000 without the dividends reinvested. Lowe's is here in this black line, and the S&P 500 here is in the blue line. So we did this over a 20-year period, and then we can see that the performance of Lowe's without the dividend reinvested in terms of just capital appreciation has returned about 13% per year over the past 20 years. So that's pretty good. And that has beaten the benchmark here, SPY, S&P 500, at about 8.63% per year. So they've done, they've done very well compared to the S&P 500 over that 20-year period. Now, what if we had looked at it with dividends reinvested? So with dividends reinvested, those would have given you an average annual return of 14.21% per year over the past 20 years. So that is awesome. And again, beating the benchmark here or the market at about 9.78% per year. So vastly outbeating the S&P 500. So Lowe's has done an incredible job in returning capital appreciation and dividends to the shareholders as a part of their capital allocation strategy. Now, a couple things to remember here as they were taking on the debt during these later years. Please do remember that this is when interest rates were low. Interest rates have risen. So again, this historical return is not indicative of future returns. So you might not get the same return, but it's just great to look at in terms of an historical basis, and it could be a basis to kind of project their future growth. But again, please remember that historical returns are not indicative of future returns, so we can't just bet on this to continue to be the option that happens. But again, it has done very well. Now I want to compare Lowe's to actually Home Depot, because those are the two comparable companies in this sector. So when we do that, you can see that the performance is very closely tied. So Lowe's again is here in the black line, and Home Depot is in the blue. And again here, Lowe's in the black and in the blue. So if we look at it, with the dividends reinvested, that's the more relevant chart here in my opinion. Home Depot has the slight edge on Lowe's at about 14.43% average annual return over the past 20 years, compared to Lowe's at about 14.21%. So very, very close. So, you could have bought either of these companies and done very well over this time period. And this is like splitting hairs in my opinion. It's not really that big of a difference. The ending difference here between the investments was about $6,000. So you would have done well for investing in each of these. So that begs the question, why did I invest in Lowe's? So when I go back to my investing spreadsheet, so when I was able to get into Lowe's, I was actually able to get in a decent valuation, $196 per share compared to the market price right now at about $224. So I've already enjoyed, a 14% gain on this in capital appreciation and plus the dividends. So the valuation for me was more of the compelling argument for Lowe's because it was trading at a lower multiple. I think I got in at about 17 times forward earnings, or even lower, or not forward earnings, current earnings. and like 15 times forward earnings. So a super great valuation that I was able to get into for Lowe's, and the dividend growth because of the nature of Lowe's, the payout ratio, being 40%, and the dividend yield being lower. I was able to lock in a higher yield on cost because they're growing their dividend a lot faster than Home Depot. So if we did go look at Home Depot just quickly for comparison purposes, you can see that their payout ratio is a lot higher at about 47%. So with Lowe's, it was at about 30%. So I was able to, get in. I think that Lowe's will do a much, not better job, but will increase their dividends at a higher rate than Home Depot has. So that was basically my video on Lowe's. I believe, in summary, that the company will do very well over the next, 20 to 30 years. Again, they're in a duopoly with Home Depot. They have, this a lot of secular market growth drivers with people coming into the market being able to buy homes and improve their homes. They're focusing a lot on technology, integrating a better consumer experience. They're trying to they're trying to get a higher share in the pro segment as well. So that was Lowe's. I hope you enjoyed the content. Again, please leave a like or subscribe to the channel if you enjoy this type of content, and I'll catch you in the next one. Thanks. Bye.